Good evening, everyone. Welcome to today's webinar where we share strategies, sectors, and products we believe you can utilize in positioning your portfolio when faced with inflation and rate hikes. With us, we have Yo Hui-shi, Chen Xin Yin, and Heather Lim from our research and portfolio management team to share about fixed income strategies for a rising rate environment, why we believe Asia remains strong, and why the luxury sector is a bright spot and a good inflation hedge. So now I'll pass the time to our first speaker, Hui-shi.
Hi everyone, welcome again. US inflation is running at its highest level in 4 decades, and with the Russia-Ukraine crisis pushing up commodity prices, the risks of inflation are also skewed to the upside. And as inflation shows no sign of easing, we believe that there's a high probability of the Fed raising interest rates more aggressively. And in a rising interest rate environment, bond prices fall, dragging down on total returns. And the expectations of rate hikes has already begun to unsettle bond markets. Nevertheless, we believe that investors who position themselves well should be able to stay resilient. So today we'll highlight 4 different fixed income strategies that can protect portfolios against rising interest rates. While it is clear that bonds are negatively affected by rising rates, we believe that an exposure to fixed income is still relevant due to its diversification benefits. Over extended periods, bonds they are less volatile as compared to equities, and they can also provide us with steady cash flows. And as such, bonds they can serve as a hedge against equity market volatility, especially during periods of crisis. Besides that, we have to emphasize that not all bonds are equally affected by rising rates. So for example, investment-grade bonds, they tend to deliver poor performance when interest rate rises as they have longer durations. So as shown by the chart here, the US, Asia, and Europe IG bonds, they have a long duration of about 6 to 8 years. If you're not familiar, duration it refers to the sensitivity of the price of a bond to changes in interest rates. So a bond with a duration of 8 years would mean that every 1% rise in interest rates will result in an 8% loss in bond value. On the other hand, we also notice that global high-yield bonds, which consist mainly of those which are issued in the US and Europe, they tend to have shorter durations. However, we believe that these bonds they are likely to face greater volatility due to rate hikes as well as a quantitative tightening. So with all this in mind, the biggest question here is how investors can get the optimal fixed income exposure in a rising interest rate environment. So the very first strategy that you can consider is to reduce duration exposure. Short duration bond funds, they are a great option to mitigate the impact of rising rates in a portfolio. They carry lower interest rate risk while still providing a reasonable yield. And here we have highlighted 4 different short duration bond funds. The Lion Global Short Duration Bond Fund has a duration of slightly over 2 years, and the United SGD Fund has a duration of about 2 years, and the Unico AM Shenton Short Term Bond Fund has a duration of about 1 year. And finally, the Lion Global SGD Enhanced Liquidity Fund has an even shorter duration at less than 1 year. These funds they generally invest in high-quality short-term bonds, which underpins their low volatility in a changing interest rate environment. And in fact, in terms of the year-to-date performance, these funds have fared much better as compared to other types of bond funds. Now, moving on to the second strategy, another fixed income space that you can consider is Chinese government bonds. From a monetary policy perspective, China is in a different place as compared to the rest of the world. The divergent monetary policy between China and the US has created a positive backdrop for the onshore Chinese government bonds. So far, the People's Bank of China, PBOC, has maintained an accommodative monetary policy. And with weakening economic growth in face of multiple headwinds, including a property market downturn and a strict zero-COVID policy, China is likely to roll out more policy measures in order to stabilize the economy. And the inflation of 1.5% recorded in March, which is far lower than many major economies, also leaves a comfortable room for further monetary policy easing. And we believe that the PBOC could continue to cut rates in the first half of this year to support its economy, which may help to drive up the prices of the Chinese government bonds. And we also wish to highlight that Chinese government bonds can still offer positive real yield, which is currently rare to find in most major economies. On top of that, it's also worth noting that China has a sovereign credit rating of A+ by S&P which is comparable to that of certain developed economies, such as Japan. And historically, China's government bonds have shown low correlation with global peers, which enables them to provide portfolio diversification benefits. The low correlation is largely attributed to the fact that their performance is mainly driven by domestic factors, such as the interest rate movements in China. And so we believe that it is a good time for investors to consider including Chinese government bonds into portfolios. Now, recommended product for pure play exposure to such bonds is the ICBC CSOP FTSE Chinese Government Bond Index ETF, which is listed on SGX under the ticker CYC. And the third strategy that we highlight today is to add some flexibility into your portfolios with unconstrained bond funds. Unlike traditional bond funds, unconstrained bond funds, they exhibit higher flexibility with their choice of fixed income assets. And this includes the ability to adjust their duration exposure along the interest rate cycle, hence allowing them to better manage interest rate risk during this challenging environment for the global bond market. But one point to note is that due to their unconstrained nature, such funds can exhibit a huge variance in risk-return characteristics depending on their investment mandate. And as such, for investors who are looking to replace traditional bond funds with unconstrained bond funds, it's important to select a fund that has low volatility. Our recommended global unconstrained bond fund is the Allianz Global Opportunistic Bond Fund. It has a track record of low volatility while still being able to provide decent returns. Moreover, the fund currently has a short duration of 2.4 years, making it less sensitive to interest rate risk. And the last fixed income strategy to consider will be Asian high-yield bonds. This is suitable for investors who want higher yields and are able to stomach the volatility. Asian high-yield bonds have suffered a steep sell-off due to the turmoil in China's property sector. And the segment now trades at a spread level of about 1,010 basis points, which is one of the highest levels on record. The spread differential of about 676 basis points and 620 basis points over the US and Europe high-yield bonds respectively also suggests that Asian high-yield bonds offer significant value. And in 2021, the default rate of Asian high-yield bonds had climbed to about 7.5%, mainly because of the increase in defaults among the Chinese property developers. Moving forward, incremental policy easing in China is likely to alleviate some of the credit stress that's being faced by the developers. And while we expect default rates to remain at elevated levels, we believe that the market has likely already priced in a large degree of credit stress. Based on our findings, using a conservative recovery rate of 0%, the current spread level of Asian high-yield bonds implies a default rate of about 10%. And this implied default rate exceeds Moody's forecasted default rate of 6.2% for 2022, and it is also higher than that of the 9.1% seen during the depths of the GFC back in 2009. So what this possibly suggests is that the market has already priced in extreme levels of default. And besides that, Asian high-yield bonds, they provide the most attractive yield in relation to duration exposure that one can find in the global bond market. They have a yield to worst of about 12%, which is close to 2 times higher than the US and Europe high-yield bonds. And this comes alongside a duration of around 3 years, which is relatively short. And as a result, Asian high-yield provides one of the highest yield per unit of duration, and hence they are unlikely to be significantly affected by the rising interest rates. So all things considered, we believe that Asian high-yield bonds offer investors with attractive risk-adjusted returns. And we recommend investors who are seeking exposure to Asian high-yield to take an active approach in order to pick up the quality names. Our recommended fund will be the HSpring Investments Asian High-Yield Bond Fund. And with that, here's a summary of the strategies that you can consider to protect your portfolios from the impact of rate hikes. So you can consider short duration bonds, Chinese government bonds, unconstrained bond funds, or also an Asian high-yield bonds. And the risks of the different ideas here, they actually vary, so you can choose those that fit your risk profiles the best. And before I end off my part, I also want to share some strategies for equities. So for equities, investors with growth-heavy portfolios should consider diversifying their equity exposure to include more value-oriented sectors. and this includes financials, which are likely to benefit in a rising interest rate environment. And you can consider our recommended product, which is a BlackRock World Financials Fund. Alternatively, you may also consider commodity-related equities as a hedge against inflation. With the Russia-Ukraine crisis threatening to disrupt Europe's energy supply, energy commodity prices are likely to remain elevated. And as the world shifts towards clean energy, mining companies, especially those in the precious metal or base metal space, may stand to benefit from this long-term trend towards sustainability. And our recommended fund for commodities exposure will be the JPM Global Natural Resources Fund. In terms of single stock picks, investors should look to avoid highly leveraged companies as they may face difficulty refinancing their debt. So companies without pricing power, meaning those who are unable to pass on the increased cost to consumers, should also be avoided. And last but not least, investors can also diversify their portfolio with exposure to markets that have attractive valuations, such as Japan, Asia ex-Japan, as well as China. And with that, I've come to the end of my sharing. And now I'll hand the time over to my colleague Jing Yan, who will share more about Asian equities and the funds that you can consider.
Thanks, Fisher. So good evening, everyone, and thanks for tuning in today. And I'll be sharing on Asian markets, as Fisher has already said, and why investors should consider investing in them. So after a strong 2021, to say that market started the year on a shaky note is quite some understatement. It has been a very eventful start of the year, and it's also worth noting that even before the Russia-Ukraine conflict came to a boil, markets were already concerned with hot inflation prints and the pace of market tightening. In fact, the conflict has further exacerbated this situation, sending commodity prices, including oil, skyrocketing. Through this, we will likely see further upward pressure on inflation, which might lead to a greater pace of market tightening by the various central banks. So, how should investors position their portfolios moving forward? Asia is no exception to the volatility faced by global equity markets, and has been affected by the risk-off sentiment that has been prevalent for much of 2022 so far. Inflation is also an issue for the region, with rising commodity prices and a stronger USD as a result of monetary tightening in the US. Inflation is likely to remain persistent. Fears of Omicron disruptions also remain high due to more conservative policies, for example, in Japan and China, as well as the lower vaccination rates in the rest of emerging Asia. However, not all is doom and gloom for the region, and we remain positive on Asia moving forward. Asia remains a good diversification option for investor portfolios amidst the uncertainty in global financial markets. Geopolitical crises are difficult to predict and price, and in times of uncertainty, the only certainty is volatility. And as always, we advocate for a disciplined, diversified approach to managing it. Asian markets remain a good option for diversification as they have lower direct economic exposure, geopolitical exposure, and relatively more accommodative policies. Next, since its discovery in late 2021, Omicron's transmission rate has been extraordinary. Fortunately, the early predictions have also been proven right. Omicron's lower severity has meant that hospitalizations and lockdowns have remained manageable, in most countries at least, and many countries have already seen their daily cases peak and start to decline as well. So with relatively minimal economic disruption for most countries, this is a promising step in the global push towards endemicity. Asia remains one of the key beneficiaries of an endemic world, with many export-based and tourism-based economies. In addition, another potential catalyst is China's relaxation of its COVID-0 policy. While China authorities have stopped short of using the word endemic, they have indicated that they are looking to refine their COVID-19 control measures in order to minimize its economic impact. A relaxation in COVID policies after the current breakout could help unlock China's sizable middle-class spending, and we see the potential for pent-up demand, similar to what we've seen in the US, which could provide much-needed support to China's economy. Following that, another catalyst could be the easing regulatory and monetary environment in China. China's self-inflicted woes last year were well documented, with the regulatory headwinds and a better property sector weighing on investor sentiment. Despite that, you'll be surprised to hear that the Chinese economy managed to grow at a respectable 8.1% in 2021. Peeking under the hood, this was largely driven by robust export numbers, while domestic consumption has remained weak. Potentially, China's strong export numbers could have been driven by the easy monetary environment and the release of pent-up demand in its trade partners in the US and Europe, which has helped paper over the cracks in its local economy. With tightening on the cards in the West, we will expect to see a slowdown of this demand, and by extension, China's exports. Despite what is potentially a very significant headwind for China, they have continued to set a lofty GDP growth target of 5.5% in 2022, a higher than expected goal. To achieve this, China would realistically have to shift away from the painful regulatory and economic environment of the past year and hopefully stimulate some local confidence in its economy. In short, we believe that the People's Bank of China will likely have to ease more aggressively in order to counteract the effect of global tightening on global economic growth. And the behavior of the Chinese authorities further reinforces this fact. After delisting fears roiled markets last month, Chinese authorities have uncharacteristically stepped out in order to calm the carnage, promising supportive policies to boost financial markets and stimulate economic growth. Finally, we also like Asia for its attractive valuations. 2021 was a year of contrasting fortunes, with the divergence being apparent when comparing between the Western economies and their Asian counterparts. This means that Asian equities are currently trading at a 26% discount to global equities, as well as a 37% discount to US equities, which is significantly greater than the historical average of 18% and 25% respectively. With tighter monetary policy almost certainly on the cards, investors should continue to remain wary of richly valued stocks. While we remain positive on equities over fixed income, we reiterate the importance of searching for quality and value. Currently, we think that Asian equities offer rare and attractive investment opportunities. And for the next part of my presentation, I'll be sharing 3 funds investors can consider to take advantage. For a more generalized approach, investors can consider investing in the Fullerton Asia Absolute Alpha Fund. The fund is an unconstrained alpha fund, in which it doesn't adhere to any benchmarks when it comes to investing. Instead, it sets a total return target of 8% across a market cycle. The fund identifies investment candidates using several growth characteristics, of which 2 stand out given the current macroeconomic environment. Firstly, cyclical growth. So the cyclical growth criteria, companies that exhibit high earnings growth but with a cyclical nature, could help the fund identify companies that will benefit from the current value rotation, such as energy, material, or financial companies. The other criteria will be quality growth, and these are companies that exhibit sustainable earnings growth driven by a quality business franchise. So this could help the fund identify companies that have strong economic moats, and they are more likely to be able to pass on the higher inflationary costs to their customers and maintain their profit margin, meaning that they could benefit from the high inflation environment. Of course, when it comes to investing in actively managed strategies, especially one as flexible as this, performance is important. The 3-year performance of the fund far outstrips any of its peers. In addition, while still delivering this outperformance, the fund does not exhibit higher volatility than its peers or benchmark as well. One potential reason that truly makes this fund stand out is its ability to move into cash as a residual asset class, an advantage in today's world due to the high degree of uncertainty and volatility that we are currently facing. Historically, there have been several instances where the fund has held significant cash holdings that has helped it outperform, such as in 2019 during the US-China trade war and in 2020 during the pandemic. For investors looking for an Asian equity fund, this is certainly a very interesting fund to consider. Next will be the JP Morgan Japan Equity Fund. We hold a positive view on Japanese equities in 2022, given the steadily improving macro backdrop, supportive policy direction, rosy earnings outlook, attractive valuations, and positive corporate governance changes. Notably, while the rest of the world battles inflation and ponders monetary tightening, Japan remains highly unlikely to step back from both loose monetary policy and easing fiscal stimulus. Despite inflation likely to overshoot in the near term due to the soaring energy prices, at present, the Bank of Japan sees little need for policy normalization until inflation remains sticky above its 2% goal. In addition, equity valuations are also attractive, both on an absolute and relative basis. Japanese equities are currently trading at a forward P/E ratio of 13.4 times, representing an upside potential of 34% by 2023, based on our fair P ratio of 18 for Japan's equity market. Japan is also one of the cheapest developed markets, trading at a 17% discount to US equities compared to a historical average premium of 2%. While Japan remains vulnerable to the Russia-Ukraine conflict via the proxy of oil prices, at current valuations, we believe that the risk-reward profile remains attractive. Investors can then consider the JP Morgan Japan Equity Fund. With many options available for Chinese equity exposure, we think that the best available choice would be via Greater China exposure, with the UBS Equity Fund Greater China being our recommended fund. We like the fund for the following reasons. Firstly, tactical exposure to the Greater China region. Secondly, beginning signs of a turnaround in Chinese markets. And thirdly, attractive valuations of the hedge share market. Firstly, we like the fund's tactical exposure to quality companies, including household names like TSMC, AIA Group, and Hong Kong Exchange. Secondly, while we're yet to see any positive impact of China's easing on its equity markets, under the hood, Chinese economy is starting to show some signs of life. We're starting to see an uptick in China's credit impulse. And with credit growth typically a good sign for equity markets, we believe that this might be the beginning of a turnaround for Chinese equities. Finally, hedge shares remain attractively valued versus their A-share peers. While Asian markets have several factors going for it, including its alignment with Chinese government's Common Prosperity Initiative, as well as its higher probability of benefiting from government stimulus, we think that the time might be right to consider Chinese hedge shares instead. The major Chinese tech giants are expected to generate considerable earnings growth this year and continue to exhibit strong fundamentals despite the tough regulatory and macroeconomic environment. We believe that the current valuation has fully priced in pessimistic expectations, and we continue to favor the Chinese tech sector for its long-term growth prospects. So far, 2022 has been a year rife with uncertainty and shocks. With high inflation and rising rates detrimental to cash and fixed income assets respectively, equity remains our asset overweight of choice. To be fair, this does not come without risk. Asia is particularly vulnerable to rising oil prices given its status as a net energy importer, and even more so if the current elevated price levels eventually weigh on global growth. With the situation in Ukraine remaining fluid, investors should keep an eye on any potential further developments. However, the case for Asia remains strong, and investors looking for a diversification option at attractive valuations, which is also exposed to potential catalysts, should look no further. So this is the end of my sharing, and now I'll pass the time to Heather.
Hi, good evening, everyone. So thanks for joining us today. And today I'll be presenting on the investment opportunity in the luxury sector. So before going into the details, the main point that I want to drive across today is that over the pandemic, luxury goods was one of the bright spots as consumer demand surged. Going forward, growth prospects for the luxury sector remains bright given the continued consumption story. Additionally, the luxury sector has strong pricing power, making it an attractive hedge in a global inflationary environment. So the luxury sector has a unique trait where Europe is home to many of the big brands that are popular, like LVMH, Kering, who owns Gucci and Balenciaga, Hermes, and many more. And overall, the demand for these brands are from a global consumer base. From our calculations, about 37% comes from US consumer demand, 26% from European consumers, and 27% from Asia, with China making up half of Asia's demand. So as seen in the table on the slide, among the sectors in Europe, we are positive on the consumer discretionary sector, which makes up over 11% of the Stoxx 600 index, which is the proxy for Europe's stock market. And this sector, the consumer discretionary sector, is projected to deliver the strongest earnings growth at almost 90% in 2022, and earnings growth for 2023 and 2024 also expected to be above average. And within this consumer discretionary sector, the luxury market stands out. So now let us take a look at why the luxury sector is attractive given the current volatile environment we are in. First, the luxury sector stands as an attractive investment opportunity as it is one of the sectors that has strong pricing power. And this strong pricing power translates to earnings resilience in an inflationary environment. So as many of us know, inflation has reached all-time high across the world in many areas and is expected to remain at elevated levels. With this backdrop, the attractiveness of the luxury sector increases as the strong pricing power of the brands allows the brands to raise prices without suffering a fall in demand. And from our research, history shows that these price hikes by the luxury brands tends to be above the rate of inflation. So according to UBS estimates, top brands like Louis Vuitton have raised prices 2.5 times higher than the rate of inflation over the past 20 years. And so going forward, the luxury sector should maintain earnings resilience in comparison to other sectors with lower pricing power. So looking at an example, the case of Chanel further adds to our investment case, where across 2021, Chanel increased the price of its iconic medium classic flat bag a total of 3 times at USD 1,000 each time. And this is equivalent to a total of a 60% year-on-year increase as of November 2021. Other brands like Louis Vuitton have also enjoyed similar price hikes. So in short, the demand for luxury goods is relatively price inelastic, as most consumers who buy luxury goods are less sensitive to these price increases, as they tend to come from the middle to higher income category. And hence, luxury brands are able to increase the prices, and the price increases have historically outpaced inflation. And so we see that the appeal of luxury in a global inflationary environment rises as an attractive inflation hedge. Next, the sector not only enjoys strong pricing power, but also enjoys a strong demand outlook. So looking at the key markets, China, US, and Europe, all three demonstrate a healthy sustained demand. So first, we look at China. So in the past 2 years, luxury market in China has saw a boom as many Chinese look to luxury shopping as an alternative to experiences like holidays. Luxury goods sales in mainland China doubled to USD 75 billion in 2021, a double from 2019. And this proves that the demand for luxury goods by Chinese consumers is very strong, as even COVID-19 could not dampen their spirits. So pre-pandemic, most of the sales to the Chinese consumers were during their vacation trips where the Chinese tourists would go to Europe. But when the pandemic hit, markets were worried that the luxury sector would lose a huge chunk of its demand. However, as proven, the demand stayed and Chinese consumers found alternative ways to get hold of luxury goods, such as through shopping locally on e-commerce platforms or even at the Hainan offshore duty-free shopping island. So going forward, the outlook for the luxury market in China is bright and is set to surpass the US to become the world's largest luxury market in 2025. So what will drive this growth is first, the Chinese are getting richer, as seen in the chart on the screen. Secondly, as demand for luxury goods grow, the supply side is also developing to match up with this demand growth. So in China, consumption of luxury goods has increasingly shifted online, where it increased from an online penetration of 13% in 2019 to 23% in 2020, which is a huge increase. As such, luxury brands have been building up their e-commerce channels to meet consumers' needs. Additionally, these e-commerce channels now further increases the brand awareness, accessibility, and also convenience, which should further help to drive the sales. Finally, the policies surrounding the luxury sector seem encouraging. For example, Chinese authorities plan to transform the entire Hainan offshore duty-free shopping island into a free trade zone. And this will be the first milestone, and the first milestone will be the establishment of a basic free trade policy system by 2025 for the Hainan offshore duty-free shopping island. Similarly, on the other side of the continent, in Europe and America, the consumer appetite is strong. American and European consumers have been spending much more than what they had spent in 2019 pre-COVID on luxury goods. For example, Kering, who owns Gucci and Balenciaga, reported in third quarter 2021 last year a double-digit revenue growth with local European consumers and also 45% revenue growth in US as compared to 2019. And so this trend of the post-pandemic euphoria is despite COVID-19 resurgences and also not an entirely back to normal situation. And so this goes to show that with more breakthroughs in COVID-19 the strengthening consumer appetite and the post-pandemic euphoria will continue, which we expect to continue to drive the spending. Additionally, the luxury market should see growth as excess savings get unlocked. So over the pandemic, savings in Europe has grown significantly, as seen in the figure. And also in the US, top executives of the biggest US banks have guided an optimistic outlook as financially healthy consumers who have cash in the bank are again eager to spend. And so to sum up this section, as vaccines roll out and the world copes with the pandemic and consumption demand returns and recovers, the luxury market stands to benefit. So now looking at the investment risk, we identify 3 key points. First, geopolitical risk, where the Russia-Ukraine crisis could potentially weigh on the European continent. The most imminent risk would be in the form of skyrocketing energy prices, which could drag on the expenses of the luxury good companies. However, as mentioned, we observed that luxury brands tend to increase their prices above the rate of inflation, which means their revenue will be able to increase higher than the increase in their cost, which means that their margins would be maintained or even improving. Second, there could be a case where other factors result in a slower than expected demand, which would mean a slower growth than what we expect. For example, consumers could continue to hold cash and remain in saving mode rather than spending. And so brighter economic prospects and the COVID recovery would encourage consumers to favor spending over saving. And that will be things we look out for. Third, policy risk is also something for us to note, as policies greatly impact the growth of a sector. So looking at China, in the case whereby China changes its policy to say encourage consumers to support local brands rather than the global luxury brands, earnings of the luxury sector could be affected. Nevertheless, as of now, the policies, as mentioned earlier, seem to support the consumption of the global luxury brands. So summing up, the consumer discretionary luxury sector demonstrates attractive growth prospects. In 2021, consumption demand from the biggest markets, the US, Europe, and China grew and is expected to continue in 2022, given the continued momentum of the post-pandemic euphoria, strong spending power, and rising income. Hence, to gain exposure to Europe's consumer discretionary sector, we highlight the EMLES Luxury Goods ETF, and details are found on the screen. For more details, you can also refer to our articles on our website. So this ETF gives investors exposure to the global luxury goods sector with about 60% exposure to European names, as seen in the table. And brands include LVMH, BMW, Hermes, Gucci, Balenciaga. And so all in all, we think that the luxury industry has bright prospects and is an attractive place to be in. So that's all I have for you all today. Thank you very much.
Once again to Hui Shi, Xingyan, and Heather. So we hope this session you got to find out more about the fixed income strategies that we had to share, as well as the Asian equity market and of course the luxury sector. So with that, we have come to the end of the webinar. But before you go, we'd just like to share our next webinar that's coming up on 28 April at 7 p.m. So this webinar will be on FSM Maps, which is our managed portfolios here at fsm1.com. So this will be a quarterly update. It's for our first quarter 2022 update, where we have our senior portfolio manager, Yowiren, who'll be sharing about uncovering investment opportunities amidst heightened volatility. So if you're interested, do feel free to register for this webinar. So I've pasted the link in the chat function, and you can go ahead and copy and paste and register for this upcoming session. So with that, we'll end off the session here. So goodbye, everyone.